When a company's share price increases or decreases, it reflects how investors feel about the company's future. Here's what happens when the price of a company's shares moves up or down. 1. When a company's share price increases, what happens? When a company's share price goes up, it usually means the company is performing well or is expected to do well in the future. Investors may be happy with the company's growth, its earnings, or its plans for expansion. What do shareholders do? Investors, shareholders, may decide to hold on to their shares because the company is doing well and they expect the share price to increase even more. Some investors may also sell their shares to lock in profits. For example, if the share price was 1,000 rupees and it increased to 1,500 rupees, investors might sell to get a profit of 500 rupees per share. New investors might buy the stock at the higher price, expecting the company to continue performing well. Example: Company A's share price increases from 100 rupees to 150 rupees. Investors who bought shares at 100 rupees may now choose to sell and make a profit. Others may buy at 150 rupees, hoping the price will continue to rise. 2. When a company's share price decreases, what happens? When a company's share price goes down, it could mean the company is facing difficulties or problems, such as lower earnings, bad news, or challenges in the market. Investors might worry that the company won't perform as expected in the future, which causes them to sell their shares. What do shareholders do? Existing shareholders might withdraw their money by selling their shares if they think the price will fall further. They might be trying to cut their losses before the share price drops more. New investors might decide not to buy because they expect the share price to keep going down. However, some investors may hold on to their shares if they believe the price will rise again in the future. They might think the price drop is temporary and the company will recover over time. Example: Company B's share price drops from 200 rupees to 150 rupees. Investors who are concerned about the company's future might sell their shares to avoid further losses. Others might wait and hope the price will recover over time. Why do investors buy or sell based on share price changes? When the share price goes up, investors may feel that the company is doing well, so they buy more shares or hold on to the ones they already own to benefit from further increases. When the share price goes down, investors may feel that the company's future is uncertain, so they sell to avoid further losses, or they may wait if they think the price will go back up in the future. Simple summary: when the share price increases, shareholders may keep their shares to earn more, or they might sell to lock in profits. When the share price decreases, shareholders might sell their shares to avoid losses, or they might hold and wait for a possible recovery. The decision to buy, hold, or sell depends on the individual investor's goals, short-term profits versus long-term growth, their confidence in the company, and how they perceive the company's future potential.